So what are the property requirements to get a VA loan? What does a VA loan payment look like? And how can you hack this loan program in order to start generating wealth and passive income for yourself? I'm going to be going over all those things here in the fourth installment of the VA loan guide for 2024. Now, technically, the VA loan is a primary residence product only, but a little later in this video, I'm going to be going over a hack you can use to actually start using it to acquire investment property. But in the meantime, let's talk about some of the specific requirements that a property has to have. Now, when it comes to property requirements, the VA is pretty much looking for three basic things. They want the house to be safe, they want it to be sound, and they want it to be sanitary. Now, when the appraiser goes out, it's not only their job to assess value, but it's also their job to assess the condition of the property and make sure it fits within the VA's requirements. And while there isn't a comprehensive list of all the things that may be required to be repaired after the appraisers looked at the property, I can kind of give you a short list of things you can keep your eye on. Defective construction, poor workmanship, evidence of continuing settlement of the foundation, excessive dampness, leakage, decay, and termites or wood destroying insects. Anytime you get a VA loan, you're going to have to get what's called a wood destroying insect report. Now, in most cases, you'll get that in conjunction with your home inspection. And a wood destroying insect report is going to show if there's any evidence of a current infestation or if there's any conditions of the property that are conducive to an infestation that may need to be remedied before closing.
Rock and roll. All right, party time. Come on, take that.
Now let's talk about appraisals. As I said, the appraiser is going to go out and try and determine if the house meets the VA's requirements as far as safety, soundness, and sanitary conditions. However, an appraisal is not a home inspection. And if you're buying a house, you want a thorough home inspection. The level of depth that a home inspector goes to is far outside the scope of what an appraiser is going to do when they go out and evaluate the property to make sure it meets the VA's minimum requirements. So do not rely on the appraisal in lieu of getting an actual home inspection.
Can I help you?
Are you the supervisor here?
Yes, who are you?
I'm Inspector Raff of the United States Customs Service. Now, I suggest you guys call your wives because we're going to be here all night. We're going to check the background of each and every crate in this section, starting with this one right here.
An appraisal should take about 10 business days to be completed and returned back to the lender. Now, one thing that you will hear that is absolutely false, it's a myth, is that VA appraisals come in lower. They do not. The valuation for a property being appraised for a VA loan or any other loan product should not be any different. The process by which appraisers use to determine value is still based on comparable sales and adjustments to those comparable sales. So you should see no difference in the valuation for an appraisal done for a VA loan versus one done for a different loan product.
Stop lying to me!
I'm sorry, that was mean. I just wanted to see what you do. Why don't we do this the easy way where you don't use that and the other guy doesn't make a mess, okay?
Now, one really awesome added benefit for veterans when it comes to VA loans is called the VA Escape Clause. And basically what the VA Escape Clause is it's a document that the seller has to sign that says that if the appraisal were to come in lower than the agreed upon purchase price, that the veteran cannot be forced to buy the home. And not only that, it also states that the veteran cannot be penalized for backing out of the sale in the event that the property did not make value. Now, I'm going to let you guys in on a little bit of a secret. There's some real estate agents out there that fully understand this escape clause. And they understand that it means that if the house doesn't appraise for what the agreed upon price is on, then they have no leverage in making the veteran pay that extra money for the house out of pocket. So in the event that you are competing with another buyer out there, if a realtor receives an offer from a VA client and then they receive a competitive offer from somebody that might be using conventional financing, for example, they may decide to tell their client to pursue the one with conventional financing because they know that the conventional loan does not carry that escape clause. They know that even if the house doesn't appraise, that it's still a negotiation, that they don't necessarily have to lower the purchase price, because without that escape clause, you are still bound to abide by the contract and you still have earnest money that is at risk if you do not. So it's not uncommon for real estate agents to advise their clients to take the non-VA offer when they receive two offers that are pretty much equal in every other way.
500 yards. That's the length of 5 football fields. Just shy of half a mile.
And it's also important to note that a VA appraisal sticks with the veteran and not with the property. So if you're looking to buy a house that maybe was previously under contract by another veteran and that veteran already had it appraised, even though that appraisal may have been done recently, you'll still have to get your own appraisal because that appraisal sticks with that veteran. It does not stick with that property. Now let's do a breakdown of what a mortgage payment would look like for a veteran and also for a 100% disabled veteran. So in this example, we're going to use a purchase price and loan amount of $450,000. So this veteran is getting a VA loan and they're not putting any money down. They're going to be borrowing the full $450,000. Now for closing costs, we're going to estimate $18,000, and $18,000 is 4% of the purchase price. Now in a better rate environment, we could expect our closing costs to be closer to 2%. But here in February of 2024, for this example, we're going to assume that it's worth your while to buy your rate down a little bit and go with 4% for closing cost. Now we're going to say the earnest money for this property is $4,500, which is 1% of the purchase price, which is about typical for earnest money. And what earnest money is think of it as a deposit. It's money that you have to put down up front to take the property off the market and give you the opportunity to secure your financing to close on the home. Most sellers, whether they be private sellers or builders, are not going to take their homes off the market and give you 30 days to close your loan without you having some skin in the game. And that usually comes by way of earnest money or a deposit.
I need more money, Steve.
Billy.
I need more money.
So in this instance, we're going to say that the veteran has put down 1% in earnest money, but they don't want to come out of pocket for another dime in order to close this transaction. Well, if the closing costs are $18,000 and you've only put down $4,500, then that leaves $13,500 left over. So that's how much seller's concession we're going to be looking for here. We're going to be looking for the seller to kick in $13,500 to help pay for the bulk of the closing costs, so we don't have to bring any more money to closing. And in this example, we're going to use a fixed interest rate of 6% financed over 30 years. Now, obviously, interest rates are subject to change every day and they're based on market rates. This is not an offer to lend. This is just an example. So given those numbers, we're looking at a principal and interest payment of $2,697 a month. And principal and interest is the amount of the payment that actually goes towards the loan. But you're also going to have property taxes and homeowners insurance. Now, taxes are going to vary depending on where you live in the country. For this example, we're going to say the property tax rate is 2.4%. So 2.4% means that the property taxes will be $900 a month. And for homeowners insurance, we're going to say that the policy costs $2,400 a year or $200 a month. That leaves us with a total payment of $3,797 per month. However, if you are a disabled veteran, depending on what state you live in, you may be completely exempt from property taxes. And in that instance, your payment would not be $3,797. Rather, your payment would be $2,897 a month. Now, if you're a veteran who's been fighting with the VA in order to get the disability benefits that you deserve, go to my channel and watch the video 2 cheat codes for winning VA disability claims. And if you find that information helpful, I advise you go to VALoanHacks.com/sign up and sign up for the VA Loan Hacks course. Now, granted, the course is focused on teaching veterans how to hack the VA loan and get the most out of that benefit. But a big part of getting a VA loan is income. And for a lot of veterans, VA disability can be a large part of their income. So I've actually put a masterclass on how to beat the VA at their own game and get the VA disability benefits that you deserve. And it is in depth and it will show you step by step how to win this game. So definitely sign up for that course if you've been struggling to get the service connection and the rating that you deserve. Now let's talk about co-signers and co-borrowers. For VA loans, co-signers generally just aren't very helpful at all. For starters, the VA guarantee does not apply to a non-veteran, non-spouse, which means that you're likely going to have to make a large down payment. Additionally, the income strength of a non-veteran cannot make up for the income weakness of a veteran. Typically, the reason for adding a co-signer to a loan is because you don't make enough income to qualify for whatever it is you're trying to finance. Well, the VA says, hey, anyone else that's on this loan that's not your spouse and not a veteran, it doesn't matter how much money they make, their income can't compensate for what you don't make. Now, when it comes to co-borrowers, spouses will qualify for the full VA guarantee. And if there's other veterans on the loan, then they can use their entitlement to cover their share of the home and their share of the loan. If you have a non-veteran, non-spouse on the loan though, they will likely have to make a down payment that's equal to what the loan lacks as far as the VA guarantee is concerned. Now, the VA really doesn't care too much about this. It's up to individual lenders to ensure that they've met the requirements of whatever investors might be getting these loans on the back end. But that's typically what you're gonna see. You're typically gonna see that the non-veteran, non-spouse on the loan has to make a down payment equal to what the loan lacks in VA guarantee. So let me give you an example of what that kind of looks like. So in this example, we're gonna say we have a veteran and then we have another person who is neither the veteran's spouse nor are they a veteran themselves, and they're buying a home for $500,000. Well, the VA is going to guarantee 25% of the veteran's half. So the veteran's half of $500,000 would be $250,000. And the VA is going to guarantee 25% of that, which comes out to $62,500. But for the non-veteran, non-spouse, they're typically going to have to put down what is lacking in VA guarantee. So their half of the house is $250,000. And if they were a spouse or if they were a veteran, the VA would be guaranteeing $62,500 of their half. But because they are neither veterans nor spouses, they're not going to get that VA guarantee. So they'll typically have to come up with that money out of pocket, and that will be the down payment for the property.
Who are you?
Well, I'm an executive assistant at a major pet products company.
Dave, I don't want you to tell us what you do. I want you to tell us who you are.
I'm a pretty good guy. I like playing tennis on occasion.
Also, not your hobbies, Dave. Just simple. Tell us who you are.
Maybe you could give me an example of what a good answer would be. What did you say?
You want Lou to tell you who you are.
That's generally what you're going to find with most lenders that will even allow you to get a VA loan with a non-veteran, non-spouse. Some lenders won't do those loans at all, but for those that do, the missing VA guarantee has to be made up typically in down payment. Now you might be asking, why would anyone want to do this? The biggest advantage of a VA loan is the fact that you don't have to make a down payment. So why would anyone do it this way where they're essentially having to put 12.5% down? Well, for a lot of people, this still may be the best option. If you compare and contrast this with, say, a conventional loan, when you buy a house with a conventional loan, you have to pay private mortgage insurance every month if you don't put 20% down.
Bumpy don't own no real estate in Harlem right now. I'm the landlord and the lease is 20%.
20% is my profit, Tango. I give you that. What do I got left? Nothing, right? 20% puts me out of business and every somebody you know out of business. There's legitimate ways of doing things, Tango, and then there's this way. Not even Bumpy took 20%.
Bumpy's fucking dead.
My man.
But on a VA loan, there is no private mortgage insurance. So this option allows these folks to get into this house with less of a down payment and not having to pay mortgage insurance, and with comparable interest rates or maybe even better. So even though it's a large out-of-pocket expense that most people using a VA loan won't have, it's still a better option than some other loan products out there in terms of allowing you to not have to absorb the additional cost of private mortgage insurance every month. Now let's talk about occupancy. As I said at the beginning of this video, the VA loan is a primary residence program only. However, let's talk about how you go about filling that occupancy requirement. The VA expects you, the veteran, to take occupancy in a reasonable time frame, and a reasonable time frame is 60 days. Now, this 60-day occupancy requirement can be fulfilled by a spouse or a dependent child if the veteran is on active duty and will just be unable to take occupancy for the first 60 days. It can also sometimes be fulfilled by the spouse if the veteran can't take occupancy in 60 days due to some non-military distant employment. Now, we did talk about some of the disadvantages with having a non-veteran, non-spouse on the loan, but when it comes to occupancy, one advantage is the VA doesn't care whether the non-veteran, non-spouse takes occupancy or not. So the occupancy requirement can be completely fulfilled by the veteran alone in the event that the other person on the loan is not going to be able to move in right away. Now, when that happens, what you can expect is a lender to say, hey, if this person isn't moving in right away, then we have to factor in their housing cost from wherever they're going to be when determining your total debt to income ratio. But they are not required to take occupancy. The VA does not care about what the non-veteran, non-spouse on a loan is doing. Now let's talk about the ultimate VA loan hack. It is my belief that if every young veteran did this, they would be on the path to financial freedom long before their retirement years. So the VA loan is a primary residence program only. You cannot use it to acquire investment property, but there is a hack that you can use to get around this. And the hack is multifamily property. You see, a veteran has to live in the property that they're going to buy with a VA loan, but there's nothing that says that the property has to be a single family home. So you can go buy a duplex or you can go buy a fourplex, and as long as you live in one of those units, it is considered your primary residence. So by doing that, you can have both a primary residence and investment property. Now you may be looking at the prices of multifamily homes and thinking, hey, there's no way I'll be able to qualify for that much based on how much money I make. But when you're buying multifamily property, the VA will allow you to use proposed rental income to help you qualify. So now you're using income to qualify that you're not even getting yet. And that helps you stretch that dollar amount further and afford these properties that may be a bit more expensive because they're multifamily.
Hi, Pearl.
Where's
You don't have to raise your voice.
You pay you!
I can give you half.
You pay no, bitch!
Hey, don't talk to me like that, okay?
I'm tired of this crap.
Look, I thought I was clear in my email that I needed a couple weeks.
I work too hard.
Can I just get 2 more weeks?
I want my money.
You need to relax.
You're an asshole.
And this is not a one-time thing. You can actually execute this strategy multiple times. A lot of people think that you can only get a VA loan once, but that's not true. Whether or not you can buy another property with a VA loan when you already have one is based on your remaining entitlement. And entitlement is based on basically how much money you borrowed the first time. And if you got some left, you can go buy another house. But entitlement can be restored. And it can be restored by selling the property, or it can be restored by refinancing to a different loan type and getting a one-time restoration. Now, if you want a masterclass on this strategy on how to hack the VA loan for absolutely free, you're going to go to VALoanHacks.com, and I have a free masterclass there that breaks this down in detail, what it looks like to hack this loan and to start using it to acquire investment property and start generating some wealth and passive income for yourself. So if this is something you want to know more about for absolutely free, go to VALoanHacks.com, watch that masterclass, and learn how you can go from owning 0 homes to owning 3 in as many years. So what about VA interest rates? What kind of interest rate should I expect to get on a VA loan? Well, VA rates tend to be a bit lower than competing products, and this is something that you're going to have to look out for. The market is very competitive when it comes to conventional financing, and most lenders aren't making a ton of money on conventional loans because it's so competitive, because that's the bulk of the mortgage loans that are being written every day. So what lenders try to do is they try to make up some of that money on FHA loans and VA loans. So it's not uncommon to encounter lenders that are padding a little bit of extra profit into their VA loans so that they can be razor thin on conventional and be more competitive in the marketplace.
Greed, for lack of a better word, is good. Greed is right. Greed works.
VA loans are not unlike other loans in that you can get both fixed rates and adjustable rate mortgages. Now, typically when you say adjustable rate mortgage, it carries a bit of taboo and people run kicking and screaming. But it's important to note that there is a time and a place for adjustable rate mortgages. And let me give you an example of what that might look like. The appeal of an adjustable rate mortgages is it typically has a lower start rate than what you would get with a fixed rate mortgage. So maybe, for example, a 30-year fixed mortgage is 6%. Well, maybe you can get an adjustable rate that's at 5% for the first 5 years. And then for every year thereafter, it's going to adjust based on what market rates are doing. Now, for a lot of people, that may sound really scary, but let's say that you are an active duty service member who has 3 years left before retirement. And when you retire, you have no intention on staying in that state. You're going to move somewhere else. You're going to move out of state. Well, why do you need a 30-year fixed loan? You're only planning to be there 3 years. And even if the house doesn't sell right away, you got to imagine that you can get it sold, within several months, depending on what the market's doing. So maybe in that case, you don't need 30 years fixed. Maybe you only need 5 years fixed. So a 5-year adjustable rate mortgage would be a great option for you if it enables you to pay less interest for the first 5 years, especially considering that you may not even have that loan in that house for 5 years. You're planning on getting out of there in 3. So it's not that adjustable rate mortgages are bad loans, they're just bad for certain scenarios. It's important to understand where you are and what's going to be happening in your life to determine what's the best loan option for you. Now, it's important to note that the only time an adjustable mortgage makes sense is when it's going to save you money on the start rate. If those two rates are pretty comparable, then there's not much value in taking on the extra risk that comes with an adjustable rate mortgage. Now, there's 2 types of buydowns. One is permanent and one is temporary. And a permanent buydown is when you are buying points so you can have a lower interest rate for the duration of the loan. And a point is just a fee that you pay, and 1 point is equal to 1% of the amount of money that you're borrowing. So if you were borrowing $450,000 to buy a house and you were paying 1 point towards buying the rate down, then that would cost $4,500. Now, buying points to bring down your interest rate permanently, or what some might call a permanent buy down, sometimes it may make sense, other times it might be a bit reckless. Based on where the market is here in 2024, a lot of the loans I'm doing right now, I am not recommending people spend a lot of money on permanent buy downs. We've already saw the Fed say that they're expecting a couple rate drops this year. We've also noticed that inflation is starting to taper down. So I'm expecting mortgage rates to go down and people to have to refinance anyway. So what you don't want to do is spend a bunch of money buying the rate down when you're not going to have the loan long enough to realize those savings. If you were to just refinance 12 months after spending a bunch of money buying points, well, that money's just lost forever.
Oh, I wouldn't worry. I've taken millions from them, and they haven't stepped to me yet. Loser motherfuckers.
But what is a lot more popular right now, and one thing I want to break down and show to you guys, is what's called temporary buydowns. And temporary buydowns come in a variety of forms. You may see 3-2-1s, 2-1s, 1-1s, and I'm going to talk about how those work and what they look like. So for this example, we're going to do a 2-1 buydown. Well, first of all, what do those numbers mean? Well, the amount of numbers tells you the amount of years that you will get a break on the interest rate. So in this instance, we have 2 numbers. So this is going to occur over a period of 2 years. And the initial number is the discount off the rate the first year. And the next number is the discount off the rate in the following year. So with a 2-1 buydown, what this means is that we're going to get a 2% discount on the interest rate the first year and a 1% discount on the interest rate the second year. I want to make something clear. This is not an adjustable rate mortgage. An adjustable rate mortgage has a fixed period and then it is completely adjustable. This is not adjustable. This is going to give you a discount for 2 years and then you're going to pay your normal interest rate for the duration of the loan. In this example, we're going to say you're borrowing $350,000 at 6% over 30 years. Well, with a 2-1 buydown, you would get a discount on the interest rate of 2% the first year. So you would be paying at 4% versus 6%. And the payment for that, not including insurance and taxes, will be $1,670. And then the following year, the discount would reduce from 2% to 1%, which means you'd be paying at a 5% rate, and that payment would be $1,878. And then at the start of year 3 is when you would start paying your full 6% interest rate, and you would pay that for the duration of the loan, and that payment would be $2,098. Now, temporary buydowns are great in that they give you a bit of a break on the expenses while you transition into being a homeowner and all the additional expenses that may come with that. Temporary buydowns also buy you some time to wait for interest rates to come down so you can refinance to a lower rate and payment long term. The cost of a buydown is equal to the amount of savings. So if we just do some basic math here, if our full payment is $2,098, but that first year we're only paying $1,670, then it's saving us $428 a month, which is equal to $5,136. And if we do that same math for year 2, we're saving $220 a month, or a total of $2,670 $7,640 over the course of that year. So the total savings is $7,776. And that is also the cost of doing that buy down for that particular loan. So the buy downs only make sense when they're being paid by the seller. Otherwise, if you're paying it at closing, then you're just prepaying your mortgage and it's not really saving you much of anything. But if the seller pays for your buy down, then basically the seller is making a portion of your payment for the first 2 years to buy you some time to wait for interest rates to come down, and then you can refinance to something a little more affordable long term. As I said before, they come in different formats. You can get a 3-2-1 buy down, which means that it's going to be a discount over a 3-year period. 3% the first year, 2% the second year, 1% the last year. The most important thing is we need to be mindful of what the market is doing and what we might expect to happen in coming years when determining if we want to pursue permanent buy downs or temporary buy downs. There's also something called premium pricing, and this is a bit harder to come by currently, but when rates come down, it will be back. And premium pricing is simply when we take a bit higher interest rate in order to get a rebate from the lender, and that rebate can go towards our closing costs. So for veterans that maybe want to spend a lot less out of pocket in order to get into the house, premium pricing helped you offset some of those closing costs, and you just paid a little bit more in interest every month, and thus your payment was a little bit higher. Now, how do VA loans compare to other loan products? Well, VA loans are the best loan program out there, and it has numerous advantages over all the other major loan products, and I will go over a few of them here with you right now. As it pertains to conventional loans, VA loans have lower credit standards, they have lower down payment, and that you don't have to have a down payment at all, and you don't have to pay mortgage insurance even though you're not putting any money down. The VA guarantee is good enough to eliminate the need for you to pay any mortgage insurance, so thus you get a lower monthly payment. It's also better than FHA loans for some of the same reasons. You're not required to make a down payment and you don't have to pay mortgage insurance, but perhaps the biggest benefit over FHA loans is the loan amount. There's actually not a limit to a VA loan. You can borrow as much money as you can qualify for, whereas FHA has a relatively low loan limit compared to other loan programs. And the VA loan beats out the USDA loan as well. The USDA loan requires you to pay mortgage insurance, but it also has income limitations. So if you make too much money, you can't get a USDA loan. And USDA loans are also limited to what's deemed as rural areas. So if you're looking to buy somewhere closer in the city, then you can't even get a USDA loan. VA loans also have underwriting flexibility that other loans just don't have. There's some limitations that do not exist with VA loans because the guidance from the VA is that they want underwriters to make every loan that makes sense to write. One of those limitations that doesn't exist on VA loans is debt to income ratio. There's not a maximum debt to income ratio on a VA loan, whereas there is on every other loan product that we discussed. The VA cares more about your residual income than they care about your debt to income ratio, and residual income is a calculation that the other loan products don't even look at. And one of the biggest advantages VA loans have over all the other loan products is the seller's concession rule that we talked about in part 3 of the VA loan guide for 2024. There's no limit to what sellers can pay when it comes to the reasonable and customary closing costs. But in addition to that, they can give you inducements to purchase. They can even help pay off your debt to help you qualify for the loan. And that is not anything that can be done on any of the other loan products. Now, if you want a free one-on-one consultation with me to find out what it's going to take for you to use the VA loan here in 2024, go to VAloansWithEd.com and click the link to request a call from me. In the meantime, if you haven't watched parts 1, 2, and 3 of the VA loan guide for 2024, I highly recommend you go to my channel and watch those. And if you have, I guess I'll see you in part 5.